engagement with the Scottish Business Resilience Centre. I would like to thank all our online viewers today for taking the time to join us in this webinar and hear about debt recovery from the panel. Today, we have with us Duncan, Head of Restructuring and Recovery at Anderson & Brown. And with Duncan, we have Alistair, Solicitor, Advocate and Partner of Anderson Stratton LLP. I will now pass over to Alistair and Duncan to introduce themselves, and we will begin the session. Thank you.
Thanks very much, Prom. Good morning, everyone. Hopefully I'm coming across loud and clear. If not, just let me know. But here's the scary bit where I go screen share. Okay, so hopefully in a second you'll be able to see. Okay. Prom, maybe you could nod if you can see the first slide. You can give me a bit of confidence that it's actually working. Okay, great. So hello again, everybody. So my name is Alistair Dean. I am a partner and a solicitor advocate. I'm a partner at Anderson Stratton LLP, a full service law firm with offices in Edinburgh and Glasgow. The solicitor advocate means that I've got rights of audience in the Court of Session in Edinburgh. My specialism is commercial litigation, so commercial disputes from debt recovery, which is relevant, of course, for this talk, right through to complex contractual disputes. For whatever reason, a lot of my work tends to be within the construction sector. That's just the way it is. That's just the way it's panned out. I'm also a director and owner of Alba Claims. So you see two logos at the bottom of the screen. Alba Claims is one of the companies within the Anderson Stratton suite of companies, which is something which has been on the go for a couple of years, which offers a no-win, no-fee product in relation to commercial claims. So that's why I wear these two hats, okay, and that's why you see two logos at the bottom. I should say that before I became a partner at Anderson Stratton, I ran my own firm, which was a small niche litigation practice called ADLP. You've probably all heard of it. Yeah, and it was just really, there's only 5 people in it, but it was quite successful. So Anderson Stratton acquired that. But I mention it because what I bring into this talk, and I'm talking about debt that is due to you as business owners, is I inform that talk from my experience as being a small business owner myself, as well as having clients who come to me with problems with debt that is due to them. Okay, so that's the background. That's a bit about me. This is going to be a short talk. It's going to be 20 minutes. I think I'm going to pass over to Duncan, and then we're going to have some questions and answers at the end. But the structure of my talk is going to be this. I'm going to talk about terms and conditions, which is something which solicitors are always very keen to talk about, because we acknowledge the importance of terms and conditions. I asked the question, who are you contracting with? It seems like an obvious question, but it's a trap for the unwary. Believe me, there's all sorts of things can go wrong in relation to answering that question. And I asked that question, and I talk about terms and conditions with a view to minimizing the risk of incurring debt in the first place. But then I go on to talk about things that you can do to recover debt if you're in a bad debt situation. And I finish the talk with what I would consider to be a much overlooked area, which is interest on late payment and compensation for late payment. Okay, so and I'm going to try and make this talk, as I say, it's only 20 minutes. We're going to try to make it as practical as I possibly can do, just drawing from my experience. Okay, terms and conditions. All right, now solicitors are always talking about, what's the contract terms? Is it your terms and conditions, or is it somebody else's terms and conditions? Now, why is that so important? Terms and conditions are so important because it removes uncertainty, okay? And problems with debt recovery come in when there's uncertainty. So what I'm talking about here is that, and I know that I'm talking to a range of businesses here, and so that might cover professional services, provision of goods. So that, no matter what your industry is, no matter what business you're in, you are better off having terms and conditions than not by a long way. And these might only be 2 pages, You might even be able to squeeze your terms and conditions into one piece of A4 in small font, which is something that a lot of the a lot of the main contractors in the construction industry specialize in. You can virtually not read it. But the point is, it doesn't have to be a huge all singing, all dancing thing. Terms and conditions are critical. It's important. As solicitors, under the Law Society of Scotland rules, we have to send terms and conditions to our clients before we do any work. Okay, and it's never a problem because people expect it, and people understand that it's probably best to have that degree of certainty. Um, what are the key provisions in terms and conditions? Well, for a start, and most importantly for the purposes of this talk, payment terms. So, in other words, when are you entitled to request payment, and uh, when do you have to be paid? You know, within 7 days, within 14 days. You know, if you have a contract that's going over a 6-month period, then you obviously want to make provision for milestone payments or payments at the end of every month and so forth. Without specifying it in terms of conditions, it's completely vague as to when you're actually entitled to be paid. Payment terms, therefore, are put up front as the first bullet point. Second bullet point, right to suspend stroke terminate. Okay, now again, I draw here heavily from my experience in acting for clients within the construction industry. You want to be able, in my opinion, you want to be able to have the right to say, we are downing tools because you've not paid the last invoice, and we're not going to go on unless you pay. Okay, it's a very powerful thing, that, and it does happen a lot within the construction industry, but it happens a lot increasingly across all sectors in my judgment. And the problem is that if you don't have it in your terms and conditions, you might not have the right to suspend. Okay, that's why it's important. And I also make provision in there for termination. It may be that you're so out of pocket and you've lost faith so much with your client that you actually just want to bring the contract to an end. It clarifies the scope of the services. I think it's important for terms and conditions to say, this is what we're doing. This is what we're doing for you in exchange for the agreed sum of money. And equally as importantly, this is what we're not doing for you. Okay. Again, the lawyers have become good at this because we've had to do it because Law Society requires us to do it. Retention of title, it's a sort of legalistic expression, but it's important if your business involves selling goods to somebody or giving goods to somebody else for them to possess, what you want to ensure is that the actual ownership of these goods doesn't pass to them until such time as all of your fees have been paid, all of your costs have been paid, so that one of your remedies could be, if you're not paid, well, we're just going to come back and remove that furniture and take it back because we still own it because you haven't paid us. You can't do that without terms and conditions, okay? You can't do that. And choice of law. Again, I don't know how many businesses this applies to in terms of who I'm talking to, but if you have a contract with a company in England or a company in Spain, a company overseas, and if you don't get paid, the nightmare situation is, well, what do you do about that? Do you have to go to court in England? Do you have to think in terms of getting a Spanish solicitor? Much easier for you to be able to litigate in your own backyard, which is why if you're Scottish businesses, and I assume you all are, then you will want to have a clause that says the law of the contract is the law of Scotland, and the Scottish courts have got the jurisdiction to hear this. Okay, terms and conditions. That's my first point. Extremely important. Just to complete this, if you do have terms and conditions, right, this is an area that's rife for arguments among solicitors, is that you have to communicate these terms and conditions before you do any work. Okay, there's all sorts of problems can arise if you try to convey your terms and conditions after you've started doing work or after you've started to provide your services. So in other words, if, for example, your first invoice after, let's say, 3 or 4 weeks has got terms and conditions on the back of the invoice, the other side might say, well, hang on a minute, we didn't know anything about these terms and conditions when we agreed a contract with you, so we're going to ignore them. You can't import them. You can't impart them to us now after this length of time. So you have to be upfront about these terms and conditions. It's best if you get approval for them in writing, or even better still, if you get somebody to sign the terms and conditions that they accept, that they apply. Now, as I say, I've mentioned a couple of times, the Law Society of Scotland has made it mandatory for solicitors to do this. Now, when this came in, and this has probably been, I don't know, on the go for 10 years or something now. There was a lot of people that said, oh, clients aren't going to like it. We give them a 30-page document and we ask them to sign it before we do anything. In reality, I honestly can tell you that I've never experienced a problem with anybody saying, I'm not signing these, or indeed anybody saying, I'm not happy with these terms and conditions. Clients expect to receive terms and conditions, and I think that most clients recognize that it's entirely reasonable for you to say, not doing anything unless you accept these terms and conditions. So the perception that this is problematic, in fact, didn't come to pass at all. So it's just become part of our life now, is to issue these things before we do any work. And my final point here is send the full terms and conditions, or send a link to them. Okay. There's problems, and there's case law about it. There's problems if you say our terms and conditions apply. Okay, without making it clear, well, what are these terms and conditions? Where can I find them? What do they look like? So you want to be, as I say, you want to be completely transparent about what these terms and conditions are, and how somebody can actually have sight of them. Okay, there endeth the first lesson. Now, moving on to the question, who are you contracting with? Now, you wouldn't believe how many times over the years, I've been doing this for 25 years or so. I've been a lawyer for 25 years. I can tell you that this is a common theme. This is a common problem. Who do you actually have the contract with? Okay, let me try to, because that might seem obvious. Well, I know who I've got the contract with. It's with, X individual, X company. Let me give you an example of the sort of areas of confusion which I encounter a lot. Okay, imagine if you get an email from somebody, and the email sign off is John Smith of John Smith Plumbers. Okay, what does that mean? Because as a lawyer, the key thing is to establish what is the actual entity that you're contracting with. Are you contracting with somebody called John Smith, who has got a business called John Smith Plumbers? Is John Smith Plumbers a limited company, and John Smith Plumbers it's actually John Smith Plumbers Limited? Is there a partnership called the John Smith Plumbers? Is it husband and wife? Now, you have to clarify this. And again, we have to, and often do, clarify this with clients. It's not a problem. It's completely fair to say, can you just tell me, are you a company? If so, what is your company number? Or is this a partnership? You have to clarify this. And another quite good example would be, and again, I'm going to draw on my experience in the construction industry. If you take, for example, and I can take any number of companies, but the Robertson Group, you might have heard of. Robertson, big Elgin-based contract, huge company. You can quite often see email sign-offs from, on behalf of the Robertson Group. But in fact, there's Robertson Group Scotland Limited, Robertson Group Edinburgh Limited. If you go to Companies House, you will see there's probably about 50 Robertson Group companies, and you have to be very clear as to which company you're actually having a contract with. So once you've clarified that, then that will enable you to carry out some sort of risk assessment. And I would hope and imagine that you probably all do some sort of risk assessment. We do. It's a sensible thing to do. It's certainly a sensible thing to do if you are contracting with a company that you've never heard of before, that you don't have any trading relationship with. Well, as a firm, we use credit reference agencies, but the credit reference agencies pretty much draw extensively from the information you can get on Companies House. And Companies House is a really fantastic tool now that it's online, and anybody can register on Companies House for free, and you can really find out a lot about a company, and you can find out a lot about individuals behind the company. So, for example, let's say that you're being asked to enter into contract with a company. You go into Companies House, you find out the company was only formed 2 months ago. There's no accounts, and you realise that the director of this company has got a string of other failed companies that have lasted a year and gone bust. Lots of red flags will come up if you do that, and all of that information is available to you. It's all publicly available, and it's free. Companies House, very useful. And once you've carried out this risk assessment, there's things you can do to minimize your exposure to bad debt. The obvious one is personal guarantees. Now, something which has been creeping in recently into terms and conditions is this, and some of you might be surprised by this, is that if you're entering into a contract with a company, Some companies require signature of the terms and conditions by a director and make it clear that the director is signing not only on behalf of the company, but also signing a personal guarantee in his own right. Okay, so that's one signature on a set of terms and conditions that binds the company and also the director as an individual of that company. Now, you could call that, I don't know whether you could call that slightly sharp practice. It is, it's been challenged in the courts unsuccessfully. And if you get the wording right, you can do that. So therefore you get two for one in effect. Upfront payments, obviously, that's just an obvious thing to say. You know, we're not doing this unless we get X pounds. You know, we as solicitors get a bad reputation for sometimes saying that to clients that we don't have a relationship with. But I think the view that is often taken is, well, listen, if you can't pay something up front, then this is just more hassle than it's worth. Reduced payment terms. By that I mean that if you are being asked to sign up to a long contract where you're exposed for a 6-month period, you probably want to have a position where you can bill every 2 weeks, and then you have to be paid it within 2 days or something like that, which means that if you don't get paid, you can suspend or terminate, and you reduce your exposure to risk rather than soldier on, keep soldiering on. And I can say that I did that a lot when I ran my own practice. I fell into the trap of soldiering on a bit too much, really, to be honest, and I learned from that. You know, oh, I think he's a good guy. This is a good company. They're just going through a tough time. It'll come good. We'll just keep on going. You know, I like the guy. That kind of tends to cause problems, to be honest. And I think it's probably best if you just have an honest conversation to say, listen, I'm sorry, but I'm not doing this unless you pay me, or at least I'm reducing the scope of what I'm doing until you pay me. Okay, so that covers who are you contracting with and the sort of risk assessment steps that you can take. Now, steps to recover debt. Now, obviously, most businesses, you know, there's only a very few businesses that have got no problems with debt recovery, with debt. You know, dentists would be quite a good example of that. You pretty much basically have to pay before you're allowed to leave the place. But apart from that, most people do work and then have to get paid for the work that they've done, and solicitors are no exception to that. And the coronavirus, the epidemic, the downturn has resulted in a huge tightening of cash flowing through the supply chains in the economy. We see it. I'm sure you'll have all seen it. And I think the first question that I would ask myself is this client, is it a case of can't pay? In other words, they genuinely just can't pay, and it's in a sense not their fault, or they've just elected not to pay, and they won't pay until they have to pay. The answer to the question, if it's can't pay, then what we do, and you know what any sensible business I think would do, is just have an honest and frank discussion. And you know, there's thousands of these discussions taking place across the UK at the moment, in particular between landlords and tenants. You know, I recognise, you know, sensible discussions. We recognise that this is a tough time. What's the reality of the financial position that you find yourself in? What can you pay? What can we do to help? So constructive, sensible discussion. There's no point in being overly aggressive in the face of a client that's got genuine cash flow problems, which has been exacerbated by the economy at large. And I do know that, you know, large numbers of landlords have really done, I think, a very good job in having constructive discussions with tenants throughout this pandemic, and they've managed to pretty much reach some sort of accommodation. And so and fine if that's the case. The more problematic area is won't pay, and there's a lot of won't pay at the moment. Okay, I see it across all sectors. I'm talking here about companies that, if push came to shove, can pay you, but they've just made a decision that they're just not going to pay you until they have to pay you. And you know, I can tell you that I know of our organizations, and I'm talking about large companies that have got probably unwritten protocols in place that say, we're not going to pay that person, we're not going to pay that person, and we're not going to pay that person until we have to pay them, okay? And we're going to ignore every demand for payment until it reaches a point where we have to pay them. So the strategy in those cases, and this is just going to increase as the pandemic increases, unfortunately, is how do you get yourself to the top of the queue, to the right level, to director level, in order to get some traction, to get dialogue, to get payment, okay? Well, first of all, in my experience, if if you're not getting paid, there's going to be a lot of other people, other suppliers that are also not getting paid. So the key is to try to jump the queue to get to the top of the queue. And you have a number of things that you can do, okay? There's a number of things in the toolkit that you can do to try to elevate things to the correct level so that actually you will have a sensible discussion about payment. Statutory demands. Statutory demands, you can go online and you can get statutory demands, and it's just a form and you fill it in and you get sheriff officers to serve it on the business that's not paying you. Okay, they're quite powerful things, statutory demands. And what it's basically saying is, you owe us this, and if you don't pay us this within 21 days, we're going to deem that you're insolvent. Okay, and what can happen is that the person that owes the money maybe will write, but I say, no, we don't owe you that because we think that you've done a bad job, you've not done X, Y, Z, and that's the end of the statutory demand. But I have found over the years that serving a statutory demand by sheriff officers can escalate things to the appropriate level, put it that way. Okay, and it's quite cost effective. It's not an expensive thing to do. Another thing in the toolkit, a letter before action, an LBA. So I'm talking here about a solicitor's letter, which would say, we act for X company, you owe them Y pounds. If you don't pay, we'll go to court. Can be effective. Some people, well, quite a lot of people, whilst they will ignore internal credit control emails, are unlikely to ignore solicitors' letters. But if these things don't work, okay, and again, I can tell you that I know from experience that there are some companies that will say, we're not paying XYZ unless they raise court proceedings against us, okay? You then have to think about raising a court action. And I've said a little bit, time doesn't permit me to say very much about court proceedings, but I want to make a general observation about court actions, okay? And it's this, that if you've never been involved in a court action before, then the vast majority of court actions are resolved at quite an early stage, all right? And in reality, I use court procedure as a last resort, but I use it where I know perfectly well that the money is due, and that will be the thing that will elevate the problem to the right level for there to be a discussion and for some sort of dialogue and hopefully a resolution to be reached. Now, what I'm really saying is that when I raise a court action, I don't anticipate putting a gown and a wig on in 2 years' time, cross-examining people in the court of session. I don't anticipate that. That hardly ever happens. You would be surprised by how seldom that happens. What I hope happens is that will be the thing that will make the debtor sit up, take notice, and resolve the matter. I've highlighted here that there's 3 types of court action. One is for debts under £5,000, and I've put a link to the Scottish Courts website because you can do that yourself. It's designed for use by businesses without lawyers, okay? And it's good, it's very, very cost effective. And one of the benefits of the coronavirus is that the courts are now quite geared up for electronic submissions of documents. Things are a lot easier now in some respects. Debts over 5,000, you do have to involve a solicitor, and debts over 100,000, which I hope none of you will ever have in your lives, you have the choice of going to the Court of Session. I'm going to say no more about that, but note the penultimate bullet point. Raising an action frequently leads to a resolution, and I'm talking about 90% of the time plus. Okay. The final bullet point: insolvency proceedings. Clearly, it's not worth making a company insolvent, because if they don't mind, if they will allow themselves to become insolvent, then they don't have the money to pay you, and it's just a waste of time and a waste of money. Sometimes the threat of insolvency in particular cases can be quite a powerful threat. Okay, I'm nearing the end of the talk. I hope I'm okay for time, but give me another 5 minutes and I'll finish. Interest and compensation. I said at the start of the talk that this is a much overlooked thing, interest and compensation, in my opinion it is, and people just kind of regard interest as, oh, well, we'll ask for it, but we'll ultimately just let that go in a discussion, provided that they pay the underlying amount. Now, fair enough. I mean, most businesses do take that view, but if you have a lot of debt, and if you have a lot of historic debt, the interest can be really high, really high. I mean, so you're talking about, well, let me first of all talk about the rate. Business to business debt is covered by the Late Payment of Commercial Debts Interest Act 1998. Very powerful piece of legislation, very good piece of legislation. This is the default. This applies if you don't have any terms and conditions that talk about interest. And what it says is that interest is applicable from when you're due to be paid, whenever the contract says it, or if you don't have anything about that in the contract, then it's 30 days, okay? So interest is due at the latest 31 days after you put in your invoice. And it runs at 8 over base. And this is why I think it is interesting, because for as long as people think, well, the base rate's 0.1%, you know, interest, what's the big deal about interest? Well, 8% over base is quite a lot. It means that, you know, if you've got a very historic debt that's, let's say, 3 years old, you're talking about 24%. You're talking about a quarter of the debt due in interest. So it's worth remembering. And it also makes provision for compensation payments. I've put the compensation payments there. So this is, remember, this is statutory. This is your statutory right. For a debt of less than £1,000, 40 quid. Then you've got £70 between 1,000 and 10, and £100 for debts over 10,000. In my opinion, if you have a number of small invoices, you can apply these sums to each invoice. Okay, you don't aggregate the full amount. So you've got 10 invoices for £50 each, then in my view, in my argument, and I would argue this in a court, you've got £40 per invoice on top of that for late payment. You can also argue that if it's reasonable, you can actually ask for more than that, 40, 70, £100, if that doesn't properly compensate you. Let's take, for example, the service of a statutory demand, which might cost a couple of £100, say. Then that you've got a good argument that you're entitled to the £200, the whole amount, not just the 40, 70, 100. So I like the Late Payment of Commercial Debts Interest Act. I've noted here that the Act only applies if the contract is silent as to interest. So if, for example, you have terms and conditions that says interest will apply at 5% over the base rate, then that's it. You don't have the protection of the rest of the Act, which means you don't have the right to these compensation payments, which means that, ironically, all your best just to say in your terms and conditions, if you have them, the Late Payment of Commercial Debts Act applies. Leave it at that. That gives you the protection, it gives you the 8%, and it gives you the compensation payments. In conclusion, what I am saying is this. First of all, know with precision who you are contracting with. If it's a company, which company? If it's a partnership, who are the partners and what's the name of the partnership? Assess the risk. You can do that with a number of ways, that not least of which is Companies House, and that's a free search. Protect yourself with your own terms and conditions. That's probably my main takeaway point. Protect yourself with your own terms and conditions. If somebody can't pay, then engage in discussion and consider reducing or suspending your services. If somebody simply won't pay, reduce, suspend, or terminate your services, but move quickly to escalate recovery procedures. That's the key, is to move quickly. And I've talked about the various tools in the toolkit that you can escalate things, ending up ultimately in court proceedings. And finally, do not forget about interest and compensation on late payment, and don't forget about the powers of protection of that Act. Okay, that was a very quick canter through. I've probably just run over a wee bit. Sorry about that. I'm going to do stop share, and I'm going to hand over to Duncan for the second half of the talk. Thank you.
Thanks, Alistair. And Duncan, we'll pass it over to you to do your bit. And then all questions which I've noted from the viewers will be answered by Alistair and Duncan at the end of the session. Duncan, over to you.
Thank you. I'll just get the slides up. Thanks, Alistair. Thanks, Prom. Just to introduce myself, I am Duncan Raggett, head of the Restructuring and Recovery Team R2 at AAB, and an appointment taking licensed insolvency practitioner, or IP. I'm here to discuss the other side of the debt recovery coin and what happens if your business is struggling to pay its debts as they fall due. A recent study by King's Business School has estimated that 6 million small businesses in the UK are in a financially precarious position as a result of COVID-19, and 2/3 of the businesses recently surveyed by the Federation of Small Businesses said they expected trading to get worse over the coming months. With the ongoing pandemic, local lockdowns, furlough ending, and the rules changing every week, let alone Brexit on the horizon, uncertainty is the only real certainty in business at the minute. My part of this webinar will include some practical tips on how to keep your business going when trading through a difficult period, such as the pandemic, a run through of some of the coronavirus support measures brought in to assist, a discussion of the director's duties and what to pay particular attention to, the available business rescue options, the return of Crown preference, and what personal financial options there are. I will start with a few brief practical tips for businesses trading for a difficult period. Cash is king. Produce regular and detailed cash flow so you have no surprises down the line. Produce forecasts for all eventualities so you can analyze the impact of any additional lockdowns or continued reduced trading capacity. As income may be restricted, it's important to maximize what revenue can be generated and get cash in as quickly and as regularly as possible. Review your work in progress and see what can be built now and in the short term. You also need to proactively manage your debtor book, and you can use the methods outlined by Alistair in his talk to maximize your recoveries. Review your outgoings and see how much cash your business burns on an ongoing basis in order to minimize your expenditure. Sort your liabilities and recurring expenses by amount, frequency, and whether they are critical for ongoing trade. Where possible, stop any expenditure that is not vital. Where appropriate, use the available government support schemes. I suspect everyone is fairly up to speed on these, so I'll not discuss these in detail, but you should keep up to date with the latest announcements made and apply for any grants available to you, such as the new £2,000 to £3,000 available to those affected by the new lockdown tiers, or the grants now available to soft play centres and nightclubs. The final dates for the government loan schemes, bounce back, C-bills and CL bills, have been extended to the 30th of November. So if you are intending to take one of these out, then you should seriously start looking at the application now. Both the UK and the Scottish governments have introduced a number of measures to help try and prevent or postpone creditor action and assist business rescue during the pandemic. Some of these measures are temporary, but have been extended to the end of the year in the case of the UK-wide measures and to the 31st of March 2021 in the case of the Scottish measures. These include the temporary increase of the minimum amount for bankruptcy petitions to £10,000 from £3,000, a minimum 6 months notice required for any eviction action to private tenants, the irritacy period extended to 14 weeks notice for commercial leases, the winding up petitions to the 31st of December. No petitions can currently be brought to wind up companies on the basis of statutory demands issued from the 1st of March 2020. And even if the debt predates this, then the petitioning creditor needs to demonstrate to the court that the company's inability to pay has not been caused by the pandemic. This has meant that the majority of liquidations over the past few months have been director rather than creditor-led, but does potentially mean that there will be a lot of creditor action in the first quarter of 2021. Another measure introduced is the continued access to suppliers in insolvency. Suppliers, subject to certain exclusions, can no longer automatically terminate supply upon a company entering a qualifying restructuring or insolvency procedure. This means it should be easier for companies to trade through a restructure and maximize the chance of a sale as a going concern or survival. They've also introduced a new company moratorium and restructuring plan, which I will discuss later on. Whilst there's an increased feeling that some of these measures may have just pushed problems down the road, the suspension of winding up petitions gives directors a good opportunity to review their business now, and if required, implement a restructure or business rescue without severe creditor pressure. It's important to be fully aware of your director's duties and obligations. If it looks like your business may struggle to meet its liabilities as they fall due, then you have a duty to act in the best interest of the creditors. An IP, as part of any insolvency process, has a statutory duty to report to the Insolvency Service on the conduct of the directors for the 3 years leading up to the insolvency event. The result of these investigations could lead to director disqualifications and action potentially being raised against the directors for the recovery of assets or the losses made. This is why, as a director, it is important to seek advice as early as possible to protect yourself. Following advice, accurate forecasting, and monitoring the justification for any actions taken will all help demonstrate that you are working to mitigate the position and act where possible in the best interest of creditors. Personally speaking, as an IP, COVID-19 has to be seen as a huge mitigating factor in any director reports or action over the next couple of years. If it can be clearly demonstrated that any actions were taken as a result of the pandemic and were intended to save the business, protect creditors and jobs, then this should be taken into account, whatever the final outcome. That said, I will now give an overview of a few matters that all directors should consider if they believe they may be insolvent or approaching insolvency. Wrongful trading. One COVID-19 measure that was not extended was the suspension of the wrongful trading laws. This means that directors could potentially be held liable for any losses made if they continue to trade whilst insolvent. This seems a little short-sighted by the government, as it could lead to a lot of potentially viable businesses struggling only due to the pandemic closing down. If you are yet to take out one of the COVID support loans, then you need to consider this very carefully. If taking out any loan, then you need to justify why you're doing it through forecast and business plans and show why any loan would not worsen the overall position for the whole body of creditors. Unfair preferences. All creditors need to be treated fairly on the same basis. You cannot pay one creditor in preference to another without good business reasons. Such payments could be challenged as an unfair preference should an insolvency event occur. You need to be particularly careful with any connected creditors, such as the repayment of loans provided by the directors or guaranteed by the directors, or the payment of liabilities to linked companies. This could be interpreted as the directors benefiting personally from the payments and may also constitute misfeasance as well as a potential unfair preference. Sales under value or gratuitous alienations. If you are contemplating selling any assets to help fund continued trade, then you need to make sure that any sales are at full market value in order to not prejudice your creditors. Always get an independent valuation and where possible use independent market agents to demonstrate the best price has been achieved. An IP will review any pre-insolvency asset sales to ensure they're in the best interest of the creditors. If it cannot be shown that adequate consideration was paid, then the IP can seek to challenge the sale. The misuse of the furlough or the government support schemes. This is obviously a new matter, but one that's definitely going to be a big issue over the coming months. HMRC has estimated up to $3.5 billion in coronavirus job retention scheme payments may have been claimed fraudulently or paid out in error, which works out between 5 and 10% of all payments made. The initial deadline for reporting any errors to HMRC passed on the 20th of October, and I would be very surprised if HMRC did not aggressively pursue any companies that they feel have misused the scheme. If deliberate misuse can be demonstrated, then this would potentially constitute misfeasance or fraud, and any IP appointed would need to investigate and pursue the directors accordingly. Phoenixing. Phoenix trading is where the assets of an insolvent company are purchased by the company's directors who incorporate a new company and start to trade in exactly the same way as before. Phoenixism occurs where the new company also goes into liquidation and the assets are again purchased by the company directors. Phoenixism is very much a hot topic for the insolvency service and HMRC, who are usually the worst hit by it. And a recent measure has been introduced that gives HMRC the power to issue joint liability notices to directors where there's been a repeated insolvency and non-payment. This somewhat flies in the face of the idea of limited companies, and we're yet to see how HMRC are going to use these new powers. It is important, however, that you bear this new legislation in mind should you be considering closing an insolvent business and starting again. I now discuss a few business rescue options. Although we have a bit of a grim reaper reputation, any IP's first instinct is to try and save a business. The earlier we can get involved, then the better the chance of survival and the better the outcome for all parties involved. The new moratorium was introduced by the Corporate Insolvency and Governance Act in June of this year. It is a director-led process with an IP appointed as monitor and is designed to provide breathing space from creditor enforcement while the company considers its options for rescue. It is available to all companies with a few exceptions such as banks and insurance companies. It is currently also available to companies that have been through an insolvency procedure in the last 12 months, but this measure will expire on the 31st of December. Entry into a moratorium is achieved by the directors of the company lodging relevant documents at court, which includes a statement from the proposed monitor that in their view it is likely that a moratorium for the company will result in the rescue of the company as a going concern. This going concern statement is likely to cause the most issues. The moratorium is meant to be an easy and quick process, but any IP will need to do a lot of diligence in order to be satisfied that the process is likely to result in the company's rescue as a going concern. The moratorium initially lasts for 20 days and can be extended by credit consent to up to a year. Once in place, no action can be taken against the company for a pre-moratorium debt, but a company must continue to meet its ongoing liabilities incurred during the moratorium period, including the monitor's fees. If the moratorium fails, then the moratorium liabilities are paid first from any subsequent insolvency process. The expected outcomes of a moratorium include the recovery of the company without any further action or process, the sale or refinancing outside of insolvency, a CVA, a scheme arrangement, or a new restructuring plan. A moratorium ends when the initial or any subsequent period expires without extension, or if the company enters into liquidation, administration, CVA, or a scheme arrangement. The monitor must also bring the moratorium to an end by filing a notice with the court if they think that the moratorium is no longer likely to result in the rescue of the company's going concern, or that the company has been rescued as a going concern, or that due to the directors not providing the required information, the monitor is unable to carry out their functions, or that the company is unable to pay any of its moratorium debts. According to the figures released at the end of September, there had only been 2 moratoriums used since they were introduced in June. This is not overly surprising due to the suspension of creditor action currently. Once creditor enforcement begins to crank up again, we may see more moratoriums come to light, but there will still be the issue of how the IP will verify that the company is likely to survive as a going concern. The restructuring plan was also introduced by the Corporate Insolvency and Governance Act. It is a new procedure for companies that have experienced or are likely to experience financial difficulties that will affect their ability to continue as a going concern. It is a compromise arrangement between the company and its creditors and/or members, and any class of them. It is designed to eliminate, prevent, or at least mitigate the company's financial difficulties so they continue to trade. It broadly follows the idea of the existing scheme arrangement process. Creditors and/or members are divided into classes based on their legal rights, and each class must vote on the proposed scheme. If all classes vote in favour of the scheme, 75% of value and the majority in number, the court must then decide whether to sanction it. If certain conditions are met, then the cross-class cram-down can be applied by the court, binding classes that have not voted for the scheme to it. A restructuring plan confirmed by the court will be binding on all parties involved, and parties' rights following confirmation of the plan will be provided for as in the plan, and any previous rights extinguished. As with the moratorium, there's not been much use of the new restructuring plan to date, with the only high-profile case being that of Virgin Atlantic thus far. It has the potential of being a useful tool for business rescue, but is likely to be used more for large, complex organizations than needing a restructure than SMEs. CVAs are often in the news, as high-profile retail companies such as New Look recently pushed them through as a means by which to renegotiate leases or reduce store numbers. They are not just for big companies, however. They are a very flexible restructuring tool that can be adapted to the specific circumstances of the company involved. A CVA is a legally binding agreement with creditors which allows a portion of the company's liabilities to be repaid over time. A CVA requires the approval of 75% of the creditors, but once in place, it allows the companies to continue to trade and the directors to remain in place while reporting to the appointed CVA supervisor. They are not often used in Scotland for some reason, but I'd expect them to be utilised more as we come out of the pandemic to allow viable businesses to get back on their feet. The first objective of the administration process is the rescue of the company as a going concern. In the right circumstances, administration can be a quick and effective business rescue tool that can benefit both the company and creditors. Provided there's sufficient funding in place, an administrator can continue to trade the company whilst marking the business and assets for sale. If a purchaser cannot be found, then the administrator will move to realise the company's assets for the benefit of the creditors. It's also possible to do the marketing as a pre-administration process and then appoint an administrator to complete the sale. This is known as a pre-pack, and although it can be a controversial option, particularly when connected parties are involved, if done properly and CIP 16 compliant, it can be a great tool to save jobs and ensure the future of a business. I'll now just briefly go over the reintroduction of Crown Preference. Crown Preference is being reintroduced from the 1st December 2020. A preferential creditor is one that gets paid first in any insolvency procedure, after any fixed securities and the costs and expenses of the process, and before any floating charge creditors and unsecured creditors. Currently, the main preferential creditors are employees for wage arrears and holiday pay. On the 1st of December, HMRC will receive secondary preferential status, i.e., they are paid after employee arrears but before any floating charges, all taxes collected and held by businesses on behalf of other taxpayers. These include VAT, PYE, employee NI contributions, student loan deductions, and construction industry scheme deductions. The rules will remain unchanged for taxes owed by businesses themselves, such as corporation tax and employer NI contributions. This has been a controversial policy decision as it runs contrary to the business risk culture that the government professes to want. It will make refinancing a lot harder for businesses as the risk for lenders with floating charges are a lot higher. It is likely to lead to fixed charges being required or increased personal guarantees from the directors to support any lender. It also may mean that HMRC are more aggressive in their recovery strategies in the future. The position is exacerbated by the COVID-19 crisis and the various tax deferrals that have been offered. Companies are currently running with a higher HMRC debt than usual, and after the 1st of December, the majority of this will have a preferential status in any insolvency. Although this protects HMRC, it means that lenders are looking at severely reduced recoveries and is likely to have an impact on any personal guarantees that directors may have in place. I would recommend that directors check their personal guarantee situation and get advice now, as although currently they may be covered, come the 1st of December, they could find themselves potentially on the hook for substantial sums through no real fault of their own. I will now briefly go over some of the personal options if you have personal guarantees that you may not be able to meet, or simply some personal debts that you're struggling to pay. If you have concerns about personal guarantees or PGs, then you should check the paperwork and whether the guarantees are secured or unsecured. A lot of PGs get secured over personal assets, and you will want to make sure you deal with these ones first. If you do not recall signing a PG but are being pursued, then request the paperwork from your lender and seek legal advice. If you know the PG is valid and payable, then often the best idea is to be proactive and see if a deal can be struck with your lender. Work out the maximum you can afford to pay and over how long a period, and seek a full and final settlement. In the current climate, lenders, especially mainstream banks, will be under pressure not to pursue matters too aggressively, so they'll like to be happy to come to a sensible agreement. They'll also like to get a better return from agreeing a settlement than from any personal insolvency process. If your personal finances have reached breaking point, then there are several options available to you. Always seek advice from an IP or an accredited money advisor before taking any action, as they will impact on your credit rating. An IP or money advisor will be able to discuss all options in detail and work out the most appropriate route for you based on your circumstances. A few of these options include a debt management scheme, which is essentially getting your creditors to agree to an informal payment plan based on your available income. Some debt charities run debt management schemes free of charge, but you need to be careful as some private firms will charge you for operating it, meaning less money goes to the creditors. If you are under increasing pressure from your creditors, then you can apply for a personal moratorium with the accountant of bankruptcy. This is designed to give you breathing space from any creditor action while you review your options and next steps. The moratorium period has been extended 6 months from 6 weeks by the Scottish Government's COVID-19 measures, which have also removed the limits of moratoriums per year that a person can apply for. No action can be taken against you during the period of moratorium, but it's likely to affect your credit rating and interest will not be frozen. The Debt Arrangement Scheme, or DAS, is a legally binding arrangement that lets you repay your debts on a full rate while leaving you enough money for your household bills and living costs. All interest or charges are being applied to your debts will be frozen at the point when you apply. Your creditors cannot contact you or take any further legal action against you, and once complete, your debts will be paid in full. A trust deed is a legally binding voluntary arrangement with your creditors in which you pay a contribution from your free income over 4 years towards your debt. All debts at the date of the trust deed are included and the interest is frozen. Any personal assets you have are likely to vest in the trust deed and will need to be realised for the benefit of your creditors. The cost of the process will be met from the contributions made. There is a risk of bankruptcy should your creditors reject the proposal or if you do not comply with the agreed terms, and you can still be a director of a company when you've signed a trust deed. There's also the option of sequestration, which is formal bankruptcy. Although you can receive personal discharge within a year, if you have surplus income, then a debtor contribution order will be put in place that will last for 4 years. All assets at the date of appointment vest in the process and subject to minimum levels will need to be realised for the benefit of your creditors. There are a number of restrictions placed on you if you're sequestrated, one of which is that you cannot be the director of a company. In summary, if you're experiencing financial difficulties, then remember, cash flow and forecast as accurately as possible. Maximize your income, minimize your expenditure, keep detailed records of all decisions made, and seek advice as early as possible. Not only does this protect you as a director, but the earlier you get advice, the better the outcome is likely to be. I hope this was helpful to you all. Both Alice and I are happy to take questions now, or if you wish to follow us up with us separately, our contact details can be found on screen. Thank you very much.
Okay, thank you, Duncan. We have some questions from the audience and I'm going to read them out. And if you or Alistair prefer to answer them together or take questions alternately, it's fine. So we have a question from Derek, and it is, how are the courts coping with COVID? Is there not a big backlog that delays pursuing claims?
Yeah, so I can answer that, Prom.
Thank
Yeah, at the start of lockdown, the Scottish courts dealt with lockdown very badly, I think, really. They struggled to understand how the courts could keep moving. And in fact, to be honest with you, for a while, courts just ground to a halt. And a lot of companies knew that, and that's why they didn't actually pay a lot of debts, because they knew that there's nothing that could be done about it. But I'm now pleased to say that the Scottish courts have got their act together in a way that probably they should have done years ago. There's lots of virtual hearings. There's lots of emails with the sheriff and the sheriff clerk. In other words, the coronavirus has dragged the courts into the 21st century, and it's here to stay now. So there is a bit of a backlog, Derek, but the courts are coping, and they're getting better at coping as the weeks go by. And the courts are open for business, is the message.
Okay. Thank you, Alistair. The next question is from an attendee. I don't have the name. It's an anonymous one. Can a non-statutory director be pursued if they have signed a contract?
If in a sense of a personal guarantee, or like, I mean, if they've signed a personal guarantee and they're not sure about it, then they need to get the paperwork and double check that and get some legal advice on it. Because but as Alistair said, obviously a lot of the contracts now they have a little clause in it about personal guarantees, and not all directors are always entirely au fait that they're actually signing. So the best thing would be to get the paperwork and have a look and get some advice on that.
Yeah, if I just follow that up, Duncan, I agree with you. I think, yeah, if what we're talking about here is a situation where a non-statutory director has signed something which appears to bind that person personally, a personal guarantee, then I think the answer to the question is likely to be yes, they can be pursued. They can be pursued. I don't see why they couldn't be pursued.
Okay, thank you. The next question is from one of our attendees. I don't have a name. COVID restrictions are having an impact on existing contracts we are delivering and adding additional costs. What are my rights to either to claim those additional costs or walk away?
Yeah, so this is maybe more of a legal one, although Duncan may have some input here as well. But this is a big question, and it's a deceptively difficult question to answer, because it depends on a number of factors, depends on what sort of contract it is. I'm going to say this, that in the absence of terms and conditions, which specifies what happens in the event of something like a pandemic, then I think it's a problem saying that you're entitled to additional costs. I think it's a problem, okay? In other words, what this pandemic is what you might have heard the expression force majeure, you know, like an act of God. But these force majeure clauses only work if you've actually got a contract that specifies what happens if a force majeure event comes along. So I think it's difficult, but what I am seeing across a lot of sectors is clients picking up the phone to their customers to say, listen, we actually can't do this anymore for the price that we agreed. We simply can't do it. So I'm either going to have to bring the contract to an end, or we're just going to have to agree some sort of a revised rate. You might as well have that discussion. And I do know anecdotally a lot of clients of mine who have had that discussion with customers, and they've just agreed something that's just pragmatic, sensible. Okay, why don't we agree that you've got a bit more time to do it, and we'll slightly increase your rates. So it's worth a discussion. But if you don't have the discussion, it's not easy just to say the coronavirus has resulted in my not being able to do it, therefore the contract's over with. That's quite risky.
Yeah, I mean, I would agree with Alistair. I mean, I would say, I mean, actually, you know, everyone's in the same boat. So actually, people are going to be more open to, you know, extending things or having a sensible discussion and coming up into a sensible conclusion. Because it might be that it can't be fulfilled now for that price, but you know, if the work still needs to be done and the company still needs it, then it's in both parties' benefit to come to some sort of arrangement.
Yeah, I agree with that.
Okay. Thank you both. The next question is from Atul, and it's sometimes clients will either pay a proportion of the debt, just enough they think, so that no action will be taken. Words like I am broke just now, I'll pay you £2,500, or if it's a small bill, say up to £1,000, they just won't pay as it's not worth the bother of pursuing them. Any advice on those de minimis cases?
Well, yeah. My advice is that, well, you'll recall that in one of my slides, I gave the link to the Scottish Courts website for dealing with de minimis cases, which is claims that are less than £5,000. And what I would do in this situation is this. Let's say that you're owed £5,000 by somebody. You might want to proceed to actually start a court action against them. And then if the person says, listen, you raise a court action against me, all I can do is pay £500 a month, you might then say, okay, fine, provided it's in writing, an email exchange saying, okay, you've agreed to pay £500 per month, that's fine. We're going to put the court action on hold, but if you are late with any of your payments, I'm going to go reawaken that court action and pursue you for the full amount. So I think it's quite helpful to have a court action in the background raised, but put on hold. And that's a very easy thing to do. It's there, it's in the background. It's the threat that you can invoke if there's a failure to pay an installment payment.
Yeah, and actually referring to something Alistair said in the thing about obviously sort of it might not be enough payment, but you can actually, there might be other creditors. If you're not paying you, they're probably not paying other creditors. So there might be other creditors there that have similar amounts, and you can actually, if you know of these other creditors, you can actually work together and take action together as well to get it up to a certain level to do something if that was the case.
Okay, thank you. The next question is from Emma. To what are the clauses to look out for that can supersede the right to terminate a clause?
So I don't know if Emma is able to put herself on mute and because I don't quite understand the question. I saw that. I don't quite understand the question.
Let me just see if Emma can. Attendees. I don't know. I'll check with Claire. I'm not too sure, Alistair. What we can do is if you can give some kind of advice, and then Emma, if you can you drop us an email or expand it a bit more?
I think, yeah, I mean, just the way it's worded is I'm not quite sure what Emma's angle is on it. I just think that maybe what I might suggest is that Emma just maybe gives me a call or something like that. I mean, if it's a specific case, I'll be happy to have a chat with her.
Okay. Okay, Emma, I hope this, I mean, as Alistair said, he's very happy to chat to you about it and go in a bit more detail. And these are all the questions we've had from the attendees. If anyone has any questions, please feel free to email the Scottish Business Resilience Centre. But I want to take the time to thank both Alistair and Duncan for being present today and running this webinar with ourselves, and also all the attendees who have been kind enough to attend the session. This session is recorded and will be available on YouTube. So if you missed anything, you want to go back, you want to get details, or you want to have a bit more discussion, please feel free to go onto the YouTube for Scottish Business Resilience Centre or drop us an email, and we're more than happy to help you. This is a time when we're all working together. So it's all about collaboration and helping businesses. That's the aim of Alistair, Duncan, and us. So we're here to help businesses. So don't feel shy. Please just ask us. And I think it's always better to ask than not to ask. Any last words of wisdom, Alistair, Duncan, to the team?
No, thanks very much, Prom. You know, I'm not used to doing these webinars, and I have to say that this has been really efficient. It's been I've really quite enjoyed it, and I'm just happy to help. So thanks to you for hosting, and thanks everybody for attending.
Thank you, Alistair. Duncan, anything you would like?
Yeah, thanks to Prom, the Scottish Business Resilience Centre, and thanks to Alistair for his part as well, and on attending. I mean, again, to reiterate, we're here to help. And as I said in my thing, that the key is to get advice as quickly as possible if you have any issues. And an initial chat with any IP, it would just be an initial chat. There won't be any, people. We're here to help, and we're happy to have a discussion, even if it's only going to be a 20-minute chat, and then nothing comes of it. We never hear from you again. That is fine. Sometimes just getting the peace of mind is what you need. So please do.
Thank you, everyone. So please, again, I'm reiterating, please don't feel shy or hesitate. Just email and ask us for help. We're here to help all businesses in Scotland. Thank you everyone for your time and have a great day. Bye.
Bye.